Hello traders, Gary Wagner here. Just about 1 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. First day of March 2019, and this is the daily report for gold and silver, our weekend review, and what a week we have seen, especially an ending like we have seen in gold, down about $22 on the day. Interesting action with all of the precious metals lower except for palladium. Actually closed up a little bit. On today's show, I really want to focus on two markets, gold and palladium. We're going to do it through two charts, and what you're going to see is that our technical studies actually indicate that there is more upside room in both of those precious metals. You might not be that surprised about palladium. It's been on a tear, but gold has corrected and corrected hard. But I think I'll show you through technical evidence why I believe that there is a decent probability that we have run out of steam in terms of the correction, and we will see higher pricing next week. In terms of the market itself, gold down about $22. $1,294.50. Silver took it hard, down 40 cents at $1,252. Platinum down 1.5%. That closed down $13 at $862. But palladium, my friends, $15.03, up $1.70 on the day. Now, without going through all of the numbers, one of the big issues was the risk on market sentiment as we saw higher prices in U.S. equities today. This is going to be an interesting week as we move into the first week of March. Enjoy the show. Here come the technical studies. Traders, to say that this has been an interesting week has been an understatement. I want to take a look really at two primary charts today, one of platinum and one of gold. The first one we're going to look at is a gold chart. And on this gold chart, I've basically subdivided it into three primary sections. The first section is the lows that it hit in August when the market went to 1167, and from there traded up to $1,246. The second thing that I'm going to look at is the following correction or retracement, which went from 1246 down to about 1195. And then the third thing I'm going to look at is the last rally we saw from approximately 1200 to 1350. And then lastly, I want to cover recent activity, which is the correction in gold that we have seen occur over this last week and a half, in which the market hit a low today of 1291.30. And as you can see from the Fibonacci retracement areas, and I'll explain that in a second, the 0.38% retracement level comes out to 1291.20. And the reason I bring all of this up is because I believe that it is quite possible that the correction really did itself in today, has concluded, and we could see prices firm from this point forward. And let me explain what I mean by that. Typically, in Elliott wave theory, we are looking at a total of a count of 5. Of the 5, we have waves 1, wave 2, wave 3, wave 4, and then wave 5. Now, in these waves, we consider 3 of them impulse waves, or waves that move in the prevalent trend direction, and that would be waves 1, 3, and 5. We also believe that there are 2 corrective waves, and the corrective waves that we are looking at in terms of their number sequence are waves 2, right here, and then waves 4. Now, in Elliott wave theory, the belief is that of these 2 corrective waves, one of them will be extremely deep. It can be the first or the second one. And then the other retracement is basically going to be fairly shallow. We also use our basic Fibonacci retracement numbers as a proper place to look at that. With that in mind, let's see what's going on. The first rally here from 1167 up to 1246 when it retraced, the correction it had came out to almost a perfect 0.618% retracement. That's 1197, and the market went to about 1195. So that's right here. And what that means is that it's most likely that the next correction, and the next correction that, of course, I'm talking about is going to be our wave 4 correction here, is going to typically be a shallow correction. So when you get the first correction being deep, it's going to be at least 50%, probably 0.618, and it can go as low as 0.78. And then your second level, which is what we're experiencing right now, that should be shallow. Now, this is just a rule of thumb. It doesn't always apply, but for the better part of the charts and the moves that I look at, this is a very good rule of thumb to follow, or at least be aware of. And the reason I believe we could have concluded this particular correction is that this most recent move down is a perfect 0.38% Fibonacci correction. And that, to me, really is interesting. And the reason that it's so interesting is that it's right on target. So we had our first correction that came in pretty much at a perfect 0.618. And then we had our second correction that pretty much came in at a perfect 0.38. And what that means is that we have now seen waves 1, our corrective wave 2, our largest of the impulse waves, wave 3. We've now seen our wave 4, which means that we will probably begin to see a fifth wave emerge over some part of next week. If that is the case, that is the point that we're going to look to get long, and we will calculate our basic strategy or target for exiting once that happens. And what we want to look at is basically a one-to-one relationship between wave 1 and wave 5. And the other way to do it is to look at a 0.618% relationship between wave 3 and wave 5. In either case, we will certainly look very, very closely to enter the market from the long side. Now, as I said the other day, I did zig when I should have zagged. We took a short trade that we were stopped out of. We went long at roughly 1326 as the market was running after the announcement came out that Trump abruptly left the summit with Kim the other day. We put an initial stop $20 below at 1306. However, if you remember from yesterday's show, I mentioned I really didn't like it. We were down $11, and I said, conservative traders, just go ahead, get out of the trade, and take a much smaller loss, that loss being $11. I am sorry about that, but we are still in good profits for the year. More importantly, what we are looking at in this chart is the real potential to see a nice, solid rally emerge in the next week or so from gold. And traders, as I said, there are two basic markets we're going to look at today, and I'm going to be using a total of 3 charts to illustrate my point. We've just looked at the one gold chart. We're going to look at 2 palladium charts. Both of them are extremely long-term views. They are monthly candlesticks. This first chart just shows the current rally, which we can easily see began in January of 2016. It is going on till today, February. This is, of course, January of 2019. And in that, we have seen this market move from $454 to $1,552, approximately a $1,100 move. In other words, a 300% gain approximately in the price of palladium. I've never seen this market move in quite this fashion. No one has. But here's what's interesting. I really believe that there is more room for this market to move. And the way that I'm going to look at it is through a monthly chart by using Fibonacci extensions as well as Fibonacci retracements and doing what we call a crude Elliott wave count. Because what we're going to see is this. When we look at this move, it's the same move that we just saw after having the market be in a defined downtrend. We then started our upward ascent. We definitely had a first leg or a wave one of this rally, and that took the market from about $450 to $1,134. Wave two was absolutely a correction of wave one, taking us to about $811. And in terms of where that took us, what we want to do is a Fibonacci retracement at 811. It is not quite 0.618 and it is not quite 0.78. It really comes out to almost 0.70. So it is a deep retracement, deeper than the 0.618, but still quite acceptable because it is well above the 0.78% retracement. From there, we go into this current move that we're witnessing right in here, and this is the move in which we have seen this market go from about $810 up to these current highs well above $1,500. Now, here's what I find is interesting. In terms of basic Elliott wave theory, there are three golden rules. And one of those golden rules basically says that wave three cannot be the shortest of any of the impulse waves. That being said, we have basically met that criteria because when we look at our starting point here to the highs, a 1-to-1 extension of wave one here in terms of price move to wave three here comes out at 1497, and that is where I derive my initial call that we would see this market move to about 1500. The market closed actually at 1502, and oddly enough, of the precious metals, they all closed lower on the day, with the exception of palladium. Palladium up 70 cents on the day. The reason I believe that it could go even higher before we see a correction is although a 1-to-1 move is acceptable, what we typically look for is a much greater extension. It can be a 1.23, a 1.382, and I've seen it go as high as 2.618, but typically what we'll see is a 1.618% extension of wave one in an extremely robust rally. And anybody who looks at this chart and doesn't think we're looking at a robust rally really needs to look at the chart in a different way. So we have this wave one here. We get a defined correction that comes right within the criteria that we're looking at. We've seen it go a little past 1-to-1, but it could go much higher. The highest I think it could go would be that 1.618% extension. That comes in close to 2,000, and I think that that's realistic. However, if it goes shy of that, in other words, 1922 is much too strong, we could easily see it go to 1,750 or 1655. These are logical numbers. They are basically based on Fibonacci number sequence. They have held weight time again and time again in terms of the market. We have actually achieved our 1-to-1, so we could be looking at the top. However, if it's going to move higher, our next real level that we want to look at is $1,650. As I said, quite interesting week from both of the charts that we have looked at. I believe that we witnessed a strong correction, but a shallow correction in gold. Came in at the 0.38% retracement because the first one came in at the 0.618% retracement, so that follows suit. We've had a pretty deep correction here, so that on our wave two on palladium. So my sense is that once we do get a correction, it's more likely going to be a shallow one, but a shallow correction after the markets move this far is still a lot of dollars. So I think we could see higher prices continuing in palladium. I think we could have seen gold bottom out. In other words, I think that both markets are headed higher next week. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.